Okay, welcome everyone. Welcome to Principles of Accounting 1, Financial Accounting. I am your host and your professor, Dr. B. I will record a separate section for week 1 that we missed, so that way I'll provide you some additional information from week 1. My apologies again about missing week 1 due to my father's passing and all of the chaos that has been happening in my life throughout the last week. Unfortunately, I had to miss our first session together, but I will make it up to you by providing a recording to the content from last week. We are currently in week 2, September 7th through September 13th, and in week 2 we're going to cover chapters 3 and 4. Every single week we'll cover 2 chapters. So for those of you who are having trouble accessing content, I just want to quickly show you, I created a brief video that I sent out this morning. It's called Course Overview. In that video, I cover all of the content in the course, and that's not what we're going to do today. Today, I want to show you how to get access to the course content if you're having trouble. Some of you are having trouble accessing your textbook, which is a problem that the university is experiencing. The textbook issue is because the university recently went to this new program, if you will. And in this new program, the students are having trouble.
And you come back in, you won't be able to see any of the conversations we had before.
The students are having trouble accessing the textbook. This is because the university went to a new model where it's called Foliet Now or something like that, or I forget how they called it. But the problem that we're having is that the system that they're using is not good, for lack of a better word, and so the students have to then argue with the bookstore about access and things like that, which is kind of ridiculous. So I feel really bad for the students that are having that problem. It's something that I didn't foresee. I really didn't want the university going to this new model. I think it's a terrible decision, but it's something well above my level that comes from the very top, right? So
Signed the wrong book.
And the wrong book, exactly. So there's just so many ridiculous things that are happening. It's just absolutely insane. And so I just don't know what to say about that, other than I'm sorry that that's happening. The university, when they rolled out with it, it's just kind of ridiculous. So I did make a few adjustments to the classroom to hopefully help you with this process. So what are those changes? So if you select textbook on the left, there's a few pieces of information here. This first one is for this program called Red Shelf. This is what the bookstore is using, okay? They should have provided you, they should, quote unquote, should have provided you with a redemption code for Red Shelf to access your course materials. Now, if that's not the case, I mean, the bookstore should have sent you something along those lines through their Foliet program. If that's not the case, there's also this Find a Book thing through Foliet. And again, it's asking for that redemption code, so that may not be as helpful. If you have the redemption code, great, go ahead and enter it. If not, you'll need to unfortunately, you'll need to contact the bookstore in order to get that code. There are 2 other links I provided in the textbook area. The second one should hopefully work for you, and that is a direct link to the textbook for the course, and it opens up the textbook itself using MindTap. And again, if that doesn't work, it's because of that access code issue with the bookstore.
Yeah, mine's work. I don't have no problem with mine. I have a book from the previous chapter on class though, but I just clicked on mine and mine just went right straight to the book to the online book.
Great,
Because I have a hard copy and I also have the access to the online version too.
great, and that's what should happen. That's what should happen. Unfortunately, some students are having trouble with that part because of the whole bookstore code access thing. So there is no code to access the book or the assignments for this course. The bookstore issues you a code through that red shelf program in order to access the material, right? So it sounds complex. It is complex, but hopefully with you working with the bookstore, they'll be able to resolve that issue.
Hire more people for the bookstore so they can respond to emails.
Yeah, no kidding. I believe me, I hear you. They still haven't responded to mine. So, and I've even called them a few times, because I was having the same issues that you all were having. So it's just a mess. Hopefully they figure
My
it out.
go-to person is Dr. King because he oversees this department. We having problems with the books. We should reach out to him and
I
ask.
reached out to him multiple times. There's nothing that he can do either because he's been trying to reach the bookstore.
Yep.
Nobody has been responsive. He's just as frustrated. And I spoke to him personally days before the class even started and throughout, telling him, I don't have access to the book. Nobody's responding,
But
and
that's
they assigned the wrong book.
I would email our president. I would email the president and let him know no one responded to emails of anything. Respond because you keep going up. Don't stop. Keep going because this is important.
I
You know,
spoke to Mr. Hacker as well. I
yeah,
spoke
go
to
for it.
everybody
Yeah.
possibly that I could, but it's just if they can't even talk to, if professors can't even talk to nobody from the bookstore, they're not answering the phone, they're not answering emails. What
Exactly.
is there else to do?
Exactly. And that's been my frustration with the bookstore as well. It's kind of a disservice to you all, because you pay for this stuff, right? And that's what makes it more frustrating is that
Yeah, but no,
And this class is only 8 weeks. We don't
yeah.
have that much time to figure out all of this stuff when it's not our
Mhm.
fault.
Right.
exactly
You're right.
right. I totally agree.
But professor, they said came out and said, "Well, we're going to order your books for your class. Don't worry about it. Or you'll have all your books for your class." Because I didn't have to order no book, and I did get my accounting book. I got my finance information. So because they was like, "Don't come up to the bookstore. We're going to make sure that you have all your materials and everything for your class." So that's what I was waiting for. Like, okay, I ain't got to order no books. I'm thinking they going to do everything.
And
That's
here's the
what was
crazy
supposed to
part
happen,
though.
but it didn't.
When you go to the bookstore, like online, and when you put
Hmm.
your account number and stuff in and you try to click on the appropriate book for class, it'll
Right.
tell you right there and it'll say that it's required, but then at the bottom it'll say, oh, it's already been applied to your account and that you can't purchase it because it's already applied.
Yep.
So
You
when you go, it's
Exactly. And I still had
frustrating.
to buy the book like through the Synergen app. You had to go through there and pay for the subscription. And I couldn't use Google Chrome. I had to use
Wow.
the Mozilla Fox. So I had to download a whole new internet server. And I still had to buy the book, even though they said that it was going to be applied to my financial
I
aid.
tried to
That
buy the
shouldn't have
book
happened.
and it wouldn't let me do it. It just kept bringing me back to the same homepage every time I clicked to do the 4 month one. It's still refreshed and it went right on back to the same page. And then I'll go back to the bookstore and I'm like, okay, do I need to create another login? Like I'm confused.
Yeah. No, it's crazy. It's unfortunate that that's happening. It really is. And well, the good news is you have me as your professor, and I'm more than willing to work with all of you that are having these issues with the book access and things like that. I'm not going to penalize you for late submissions. Okay. I'm not going to give you a 0 for missing a submission, especially for that first week, because of all of these issues. I'm not going to penalize you all. Just be aware of that. And if we need to, we'll find a way to work around it. You know what I mean? It's just it's unfortunate, but we'll figure out a way around this. We'll work together on it. So I don't want you to, you know, get stressed out about it. I mean, I know it's stressful as it is, so just do the best you can to try to work with them and getting that access situated. But again, if not, don't worry so much about it. I'll work with you, okay? And that's my promise to all of you. So also within this textbook area, I have created a new link that should take you to the assignments as well. So under textbook, if you click on that new link, that last link under the textbook, it should take you to the assignments, and it should look just like similar to this. It'll say course, and it should say 11402 at the top, and then assignments. Assignments for this course in Cengage is chapters 2, 6, 9, and 13. Okay, so I wanted to show you that area. And some of you are having trouble through the course content area as well. So I just want to quickly go through that. So what you probably see is just the orientation module if you haven't completed that already. You need to complete the orientation module in order to access the rest of the course content. So in order to do that, you click on orientation module, go back to that original window, just keep hitting the next button in terms of pages. You need to definitely, well, come on, Blackboard, really? That only happens because it's me trying to show you through a recording. Okay, so when you come down to this course readiness survey, you have to take this readiness survey in order to access the rest of the course content. And to do that, you click to launch. Make sure that you have your pop-up blocker disabled. That could also contribute to some of the issues of being able to view the content. Then click begin, answer all of the questions. It should only take you maybe about a minute or so. And then click save and submit. And then once you've done that, and to verify that you've done that, if you go to your grades area, it should have this green check mark next to the online course readiness survey. And as long as that green check mark is there, when you go back to course content, you should now be able to see module 1, 2, 3, and 4. Does it make sense? Any question? We're okay so far. Okay, great. Great. Okay, so that is the course content area. Within each module, right now we're in module 1, we're in week 2. So each module is designed the same way. In the beginning part, you'll see a nice little picture that represents what we're covering for that respective week, the learning objectives, and what needs to be done for that respective week. In the instructional materials folders, you'll see what needs to be what should be covered in that respective week, what you need to read, the respective PowerPoints. The PowerPoints for this course, I developed with the publisher, and these PowerPoints, these are the instructor versions of the PowerPoints, not the student ones. The reason why I provided you with the instructor ones is because these have really good examples in the PowerPoint presentations. And the examples will certainly help you when it comes to the quizzes and the assignments. And then, so I've also included a couple of videos. These videos are super helpful. Each one's maybe about 5 minutes in length. There's probably a few that are a little bit longer, but
Hey, Professor,
they're super helpful. Yes, Darian.
those so I don't know about anybody else having problem with that, but the videos are not launching for me. It's saying they're not able to be accessed. They have expired.
Oh,
Like
that's so
for I
strange.
think I believe it was chapter 3. I was trying to watch the videos
Okay.
for the step-by-step analysis and stuff like that. and they won't launch on my YouTube. And I tried it on both of my computers and it's not working.
That is so strange. You said that was for chapter 3, Darian?
Yes.
Let me go ahead and take a look and see what happens. That should not be happening because they don't expire. Let's see. So Darian, do you remember which video that was?
I believe it was the 5-step accounting cycle.
Got you. Okay, let's go ahead and see what happens. Oh,
That's what comes up.
interesting.
Yeah.
Well, thanks for pointing that out. I'll fix that as soon as our session's done.
Okay.
I'm sorry about that. That's that almost never happens.
No, that's fine.
I promise you it worked when I developed the course. I apologize. I'll get that corrected as soon as I can. So strange. Thanks for pointing that out to me. I appreciate that.
No problem.
Okay, hopefully the rest of them work though. Okay, so each week is laid out the same exact way. So just so you know, there's going to be materials in the instructional materials that will help you to better understand the content. And in the learning activities is basically your assignments for that respective week. So since we're currently in week 2, you'll have a chapter 3 quiz and a chapter 4 discussion board. There will always be something in there. At the end of, I want to say it's the end of week 4, you'll have your midterm exam. And then at the end of week 8 will be the final exam. But don't worry, we'll have sessions to kind of, and I'll make it fun. There'll be like mini training sessions, if you will, for the exams to help you through. Okay, so let's go ahead and talk about chapter 3, which is where we are currently. But before we get started with chapter 3, I'm so happy that I have 10 of you in the room with me right now. So I do want to do just a kind of like a quick icebreaker thing. So if you wouldn't mind, I'm going to ask you how you pronounce your name, what you prefer to be called, and tell me something about what you hope to learn from this class. I know that it's required, but some of you might be interested in starting your own business, or you might be interested in going into management or something like that. So if you wouldn't mind just kind of telling me what you hope to get out of this class, how you think it might help you as you progress in your careers. So let's start with Amy.
So, good afternoon, class. My name is Amy Eslava. You could just refer to me as Amy. I'm majoring in business administration. I'm a sophomore at UDC Community College. And the reason I'm taking this course, as you mentioned as well, Professor, is that yes, it is a requirement, but also for my major, always been an interest of mine in business. So understanding how economics works into our daily lives is such a passion of mine. And that's my dream goal, to find my profession to be that as I grow older.
Wonderful. Awesome. Thank you, Amy. I appreciate that. Asia?
Hi. I just go by Asia, nothing really else. I just kind of hope to learn, I just think this class is pretty self-explanatory. Like, in a sense, it's accounting. You're trying to learn how to use it in businesses and in your personal life, because we all have to do taxes at the end of the day. But I guess I hope to learn an easier, more comfortable way to look at numbers, because I've hated math from kindergarten to now. But yeah. I just look forward to like making it easier and getting comfortable.
Awesome. Thank you so much, Asia. I totally agree with you. I never liked math either. I still really don't like math, actually. I know that's kind of surprising hearing me say that, right? But accounting really is not math, if you will. It's more understanding the process, okay? And it's more of a process, and it's more understanding how transactions affect business. And so that's really what accounting is. It's not so much math driven. It's more like understanding basic concepts and formulas. The formula part's a little bit math, but it's not super math, right? It's more understanding the logic behind it. And so I totally understand, Asia, and I appreciate you saying that. Oh, please don't let me hurt your name. Ayune?
It's fine. It's Anya.
Anya?
Yes, but y'all
Anya,
can.
I'm so sorry.
Yay!
Oh, hi, Darian. Hi, class. Well, I'm studying hospitality management. Um, hey, yes. And what I would like to learn is more of like, basically, yeah, how accounting fits into my everyday um task and stuff because I'm not good with accounting and finances and at all. So yeah.
Awesome. Thanks, Anya. I appreciate that. And I think that's probably something that a lot of us try to think about. So very good. I thank you so much. Let's see who's next on my list. Darian.
Hello, I'm Darian. I'm a hospitality major, but I do catering for my personal business. So
Awesome.
accounting is something that I really need to learn so that I could be able to take care of my books and don't have to pay somebody else to take care of that part of the business for me. So
Yeah.
um, I didn't really take any of my math classes or any of that serious, and stuff like that. But this class I have been taking notes and stuff because it's a lot to learn. And like somebody else said, it's crammed into 8 weeks. So I got to learn all that I can, and I got to take two because it's a required course for this class as well.
That's right.
So I'm just going to hang in there, man, do the best I can.
Awesome. I hear you, Darian, and thank you so much for sharing about your catering business. Um, what I recommend that you do for your catering business to help you manage your revenue and your expenses is you could actually get a student version of QuickBooks, which is a financial management software. And so you can enter your transactions that you learned about in chapter 2 into QuickBooks, and it'll help to generate those reports when it comes to your income statement, balance sheet, statement of cash flows, and also to help you to understand as a business owner and as a manager to really get a grasp on your business. And so I strongly recommend that you get QuickBooks to help you with that. It's a lot easier than having to manually record everything. And Darian, you and I can talk a little bit more about that. And I'll help you get set up with something like that if you're interested.
Thank you. I appreciate that.
My pleasure.
Uh,
Thank you so much. Lakeisha. Keisha, you there? You might be on mute. If not, that's okay. That's okay. Narciso.
Oh, hey there. Um, Hello, my name is Narciso Perez. I hope that you guys are having an awesome day. Um, I go by Alex, just
Alex?
because
Okay.
yeah, some people have a hard time pronouncing my name, so I just go by Alex. But yeah, you can call me either way. So the reason I'm taking this course is because, like you say, it's a requirement, and since I have an interest in entrepreneurship, so I thought that this course might give me some great insight into that. So
Yeah.
that's another reason why I'm taking this course.
Awesome. Yeah, Alex, I totally agree. And I think that this course is super important for those of you who are interested in owning a business. Because you really do need to understand how to track your revenue and expenses, especially when it comes to paying taxes and to, getting investors, or just really kind of get a gauge of how your business is doing. The only way we know a business is profitable is by looking and understanding the financial statements.
Right.
The income statement, statement of cash flows, the balance sheet. All of those are super, super important for understanding the profitability of a business. So Alex, welcome. Thank you so much for sharing. I really appreciate it.
Thank you. Appreciate you.
Thank you. Ronald.
Hi, my name is Ronald. I'm a business management major. Um, I'm taking this class because it's a part of my major and because it will better help me understand the financial sheets and the books for whenever I decide to run my own business. And I'm currently into real estate. And hopefully by this time next year or after I take this course, I'll be ready to expand my business more.
Awesome. Very cool. Yeah, that's super exciting. Thanks so much, Ronald. I appreciate you sharing.
Yeah.
So Maya.
There we go. Hi, my name is Samaya. I have like 5 years of accounting experience, and then I had a baby, but I wasn't going to go back to work because I'm terrified of daycares. So I decided to just go head back to school, and my goal is to receive my CPA.
Awesome.
And I just opened my own hair company. So my hair, like hair elixirs.
Oh,
So they're
cool.
like hair oils for children and adults. So I opened my own business this year as well.
That's
So I'm
awesome.
just applying my hands-on experience plus getting into this whole new business owner hat plus being a mom. So I just loaded my plate up because I'm not used to just sitting in the house.
I feel you, and it's super important to hustle as much as you can, because it keeps your mind sharp, and I'm super proud of you for starting that new adventure. That's
Thank
awesome.
you.
Hi, Professor. I'm sorry I'm late.
Hey, no problem, Fritza.
Oh, 1 second. Samaya, this is Lakeisha Brighthop. I would love to link up with you, sweetheart, because you already starting what I am trying to do, but I'm starting a mental health advocacy agency. But I just wanted to kind of like get some insight from, because you have the accounting experience, and also with you trying to get your CPA and all of that. With being as though you could give me more information on as far as the entrepreneur, the business ship. I would love that. And if you could shoot me your information, that'd be great.
Yeah, I got you. I'll
Oh,
send you an email.
okay. Thank you, sweetheart.
Mhm.
Very cool. Awesome. I'm glad that you all could make connections like that. That's very cool. Uh, Shernice. Shernice. I'm so sorry if I butchered your name at all. It's that New York accent that I have.
Hello,
Hi.
can you hear me?
I can hear you.
Hi, my name is Shernice, or to be called Shernice. My major is mortuary science, so this course is a requirement for me, but I would like to more about accounting and how it affects my daily life because I'm not a fan of math either. So
I
I
totally
do need
understand
this.
that.
I do need this class to just learn how to keep books as well because I do plan on opening up a funeral home someday once I finish school.
Great. That's fantastic, and that's a good line of work to be in.
Yes, it is.
Fantastic. Very cool. Thank you, Sharnice. I really appreciate it.
Yeah.
Sky.
Hi, everyone. My name is Sky. I recently just graduated from community college with my degree in architectural engineering and technology. So I figured I started last semester taking some courses to go towards my business degree. I do have my own business. I sell spiritual and holistic care products. And it's not a registered business yet, but it is my little e-commerce and I do like it. It is growing. But my goal is just like after I get my business degree, I do want to like start a consulting or get into consulting for engineering and architecture as far as like making sustainable buildings and sustainable infrastructure that is like green and energy efficient. Um, One thing I really want to work on because I did start accounting last semester is just the journals. I kind of got like lost in the journals and just kind of got scared and dropped the class. But I really want to like focus on that and then because that really does help, especially in the future. Like just being able to like I think Darian said like do your own books and stuff.
Exactly right. Yeah, I totally agree with that, Sky, and that's definitely one of the fundamentals of accounting is understanding how to make those journal entries. Um, that's how the softwares like QuickBooks, like I was talking about before, utilizes the entry points. So as you learned about, or I think as you learned about in chapter 2, when it comes to making the journal entries, we really do have what's called double entry. Or it's also known as what do you call double entry accounting. And so the way it works is that every time that we impact an account, we need to impact another account. So, like for example, if we're making a sale and we're receiving cash, it's the cash account is debited and the sales account is credited, right? So that's the concept behind double entry accounting. And so those journal entries that you were just talking about is the foundation of accounting, and all of the reports are generated through those entries. So that's kind of like how things are related. And we'll talk more about that as this semester continues. So welcome, Sky. Appreciate that. William.
Good morning. My name is William. Wood, you can call me Will. I'm majoring in business management. And well, what I'm hoping to get from this course, well, it's a requirement, but I'm also into finance and accounting and business stuff. So I love all about, those topics. So what I'm hoping to get from this class is to improve the skills on management, accounting, and, just applying into my daily life work. And yeah, basically.
Awesome. Thank you so much, Will. Looking forward to a great semester with you.
Thank you.
Yasmin.
I'm Yasmin. Hey class. My major is hospitality management. This class is required, but I am interested because maybe one day I want to I'm thinking about it now, but I don't know after this pandemic where I would want to open up a boutique hotel. So, this would definitely help assist me for future references when it comes to a business standpoint and the money side. So, yeah, I hope to, you know, learn some things that I can take with me in the future.
Absolutely. And we will get there, I promise you. Fritza. Fritz, are you there?
I'm sorry, I was on
There you
mute.
are. There you are. It's okay.
Hello, everyone. My name is Fritza Camille, and I am a hospitality management major. This will be my last semester at the community college, and I'll be transitioning over to the main 4-year. and it seemed like I'd probably be taking more business courses. Accounting is what I need, is what I want, is what I've been using for the past 2 years at my full-time job at Hilton Grand Vacations. Unfortunately, due to COVID, I am furloughed, but with this new job opportunity I have, I am still using some sort of accounting, but in a different way. It's more so my responsibility to keep track of any time we allow certain residents and residents guests to use the parking that's on site at the luxury apartment. Because if you work the overnight shift, one of the things you have to do is to tally up all of the ins and outs in the email to the company's accountant. And on their end, they keep track of how much money that the company has to pay to the property. So that was quite interesting. Another thing I realized when I did the assignment is that it broke down the fundamentals of accounting and it made sense. I didn't know it was that basic, and so I'm quite still in shock of it all. But there's no math. You just have to understand what are debits, what are credits, and learn how. This course, I think, is going to teach us how to balance books. So if you can understand the difference between debit and credit, and which transactions or revenue is considered as credit or debit, then I think we all will be fine in this course. I hate math as well, but there's no math in this. So if you're scared about math, don't be.
Yeah, absolutely, Fritz. I totally agree with that. And that's it really is as basic as you said it is. It's just a matter of understanding. You just have to get out of that mindset that this is not a math class. This is not a math driven class. This class is more driven on principle, right? That's why we call it principles of accounting. It's really breaking it down and understanding what is a debit, what is a credit, how do they balance, right? And once you get that concept down and understand the formula assets equals liabilities plus equity, which is the basic accounting equation, you'll understand that debits equal credits, and that every time I impact like an asset account, I'm probably impacting either another asset account, or I'm impacting a liability, or I'm impacting an equity. And so the accounting equation always equals assets equals liabilities plus equity. And your debits will always equal your credits because you're impacting two accounts. And that's something that we'll talk more about as we talk more about these principles. But it's just really kind of wrapping your minds around that fundamental. So thank you, Fritza, for that. Of course, I'll tell you a little bit about myself as well. My name's Dr. B. You can call me Dr. B. my full name is Dr. Brandon Schweitzer. Some students call me Dr. Schweitzer. It's a very difficult name for most people to pronounce. So that's I got my nickname here at UDC, Dr. B. I just a couple of students started calling me that, and it just kind of stuck. And so Dr. B it is, right? So, a little bit about myself. For the past 20 years or so, I've been working in some accounting capacity, if you will. I started working almost full time when I turned 15 years old in New York State, which at the time, I guess technically wasn't terribly legal, but it was something I had to do because I grew up in a very poor household. So I started working at the age of 15, contributing as much as I could to my family. I started as a grocery store clerk. By the time I was 16, I was an assistant manager of that grocery store. How'd I got there? I just kind of learned all of the ins and outs of the business. And that's really where the whole adventure started for me when it came to the accounting component, right? From there, I went into sales at a store that's out of business now. It's called Sears. And then from there, by the time I turned 18, my parents said, well, hey, we want you to go to college. I said, well, that's great. Who the hell's going to pay for it? And they said, well, you are. So I said, well, okay, let me go as far away as possible, right? So I figured if it's on my dime, I might as well make it count. So I moved to Hawaii. I packed 2 suitcases, hopped on an airplane, moved to Hawaii, and I got accepted to Hawaii Pacific University. And I got a full-time job right away as well. So I worked full-time, went to school full-time, barely slept, but I did everything I could to just make something of myself. Just like all of you are doing now. You know, most of you are working. If you're not working, you got kids, and that's a full-time job in itself, I know. You know, so all of us, we try to make something of ourselves. So in Hawaii, I got my bachelor's degree in international business, and then I got my master's degree in my MBA, also from Hawaii Pacific University. All the meanwhile, I was a manager in retail, and then in 2006, I decided to open my own business. I opened a organic wholesale, retail, and distribution company, selling organic food products to grocery stores. And it was a lot of fun. You know, I went to trade shows, I did demonstrations of food products, and I took it from 0 to $3.2 million in sales by 2011. And then I got out of that business. It was a pretty bad partnership that I was in, so the business ended. From there, I moved back to New York. My father was sick at the time, so I moved back to take care of him and the family. And I started working in the hotel business. I ended up as a financial controller for Radisson Hotels in New York State. The Radisson brand, I don't know if you know it, but it is a global brand. It's a smaller brand, but it is global. From there, from that experience, I got recruited by a company here in Maryland to work as a financial controller for a smaller hotel company. And then I started, I wanted to get my PhD, so I started my PhD studies in accounting. And from the hotel business, I started also teaching at UDC as an adjunct part-time instructor. And I love teaching so much. Like I thought accounting was my true calling, and it was great. But then I got into teaching, and I absolutely loved it. Right? You know, you all are the reason why I do what I do. I try to help you to become better individuals by teaching you what I know, and to provide you with as much mentoring and coaching as I possibly can. And so I got into teaching full time, right? And I've been doing that since 2014, and I absolutely love it. I teach here at UDC full time. I'm the only full-time instructor of accounting here at UDC. I am at the community college. My office is at 801. It's closed right now. I haven't been there since March. Hopefully, I'll be there sometime next year, depending on when things reopen. Tell you a little bit more about what I do with my students. Since I am the full-time instructor of accounting here at UDC's community college, I mentor my students. I have relationships with them where I help them to find work, improve their current opportunities. Just like what I was talking with Darian earlier, you know, since he's got this business that's up and running, I try to coach the students to help them to become better managers of their own businesses, if not in their current roles. So I connect them with resources that, through colleagues and acquaintances that I've met along the way. So here at UDC, I've also gotten students jobs through my connections. And it's just been a great, wonderful experience. And I hope to share all of that with you all throughout this semester. So thank you again for for your introductions and for spending the past half hour talking with me about this. It's really important that we get to know each other, since we'll be working with each other throughout the next 7 weeks. And some of you beyond. I am teaching the Principles of Accounting 2
Yes,
course.
taking it with you. Yes, Lakeisha.
Awesome, very cool. I'm so happy.
Yep.
So if you haven't registered for Accounting 2 already, please do it.
Dr. King made sure he registered me. He's like, you're all set. Thank you so much. Yes, thank you.
Yeah, my pleasure.
I'm trying to graduate. I'm trying to let this be my last semester. I'm trying to graduate.
I know that, and Lakeisha will get you through, I promise.
Okay.
And that's another thing to note. Dr. King and I were, Professor King and I, he's going to be doctor soon, hopefully.
Okay.
He's working on it, and I'm helping him with it.
Okay.
Professor King and I have been working together since 2014. He was a colleague of mine, and then he became my boss recently, which is awesome. I really like Professor King. I think he's a wonderful leader, and I'm sure that he will continue to express his leadership. And so he's a really great guy. I look at him as my mentor, right? So okay, so let's go ahead. We'll jump into chapter 3, and then we'll do chapter 4. I don't think it'll take too terribly long. I know that chapter 3, there's like 50 some odd slides. We're not going to cover all of those because some of them are just kind of fluffy, right? So I want to cover the important things. Since we are somewhat limited on time, I do want to cover the important ones. So let's go ahead and jump into chapter 3 slides. You all can see my screen, right? I just want to make sure.
Yes.
Yes, great. Thank you so much. I appreciate that. Once in a while, I'll need your acknowledgement, just because I can't always see what you all are seeing. So okay, so let's jump into the PowerPoint presentation. I'm not going to read through all the learning objectives. It's kind of silly, but basically, all you need to know is that in chapter 3, we're going to be talking about cash and accrual-based accounting. We'll talk about adjustments and adjusting entries. Those journal entries we've been talking about over the past 2 chapters. And we'll talk about trial balances and things like that. Okay, so there are 2 primary bases to accounting. One is called cash accounting, and the other is called accrual accounting. In cash-based accounting, we recognize revenue at the time that we receive cash. Okay? We recognize revenue at the time we receive cash. That's cash-based accounting. In accrual-based accounting, we recognize revenue at the time we make the sale, not necessarily at the time that cash is received. So what does that mean? So let's say you come to my hotel, okay? You come to my hotel, you spend the night at my hotel. I recognize the revenue at the time the reservation is made and guaranteed, okay? You stay at my hotel, I recognize the revenue at the time that the reservation is made and that it's guaranteed, okay? But that's not always the same as when I receive the cash. I receive the cash when you check out of the hotel, okay? That's accrual-based accounting. We recognize revenue at the time the sale is made, not necessarily when the cash is received. The same can be said with goods and services. So let's say you own a catering business, for example, okay? And you might use the cash base just because it's simpler, but if you used accrual-based accounting, you would recognize your revenue when you've delivered your goods, or you've performed the catering service. You would recognize the revenue at that time. but your customer might not pay you for 30 days or something like that, right? So you recognize the revenue at the time that you took care of the catering service, not when you received the cash. That's accrual-based accounting. The cash-based version of that is you recognize the revenue when you receive the cash, right? That's the primary difference between accrual and cash-based. Accrual, you're going to see accounts like accounts payable, accounts receivable. That's accrual-based accounting. Accounts payable means I got a bill for my electricity. The electric bill isn't due for another 15 days or 30 days. I recognize the expense at the time I received the bill, but not necessarily at the time that I paid it, right? The same is said with your customers. I sent the customer the inventory, and then along with that inventory, I sent them a bill that said pay within 30 days. The customer will send the cash 30 days later. I recognize the sale at the time that I sent the inventory, right? That's the difference between accrual-based and cash-based. Does it make sense? Are there any questions so far? We're good.
I have a question.
Yes, please.
So would what is it, a deposit? Like if you put a deposit towards something, is that considered an accrual base? Or is it still a part of cash?
It is accrual-based, but with a deposit, we don't recognize it as revenue. We recognize it as unearned revenue. The reason being is because with a deposit, it's like saying, hey, listen, I'm going to do this service, but the service has not yet occurred. Okay, so a deposit is called unearned revenue for the business. It's accrual based. It becomes earned revenue when the service occurs. Okay, so it goes from unearned revenue, which is a liability, to earned revenue, which is an asset, when the service occurs. Does that make sense?
Yes.
Awesome. Very good.
I have a question.
Yes, please.
So with the accrued base accounting, can it sometimes intermix with the cash? Because there's been instances at my old job where cash, but we still file just in case for incidentals. So is that a great example of both of them together, or that's just another form of accounting altogether?
Yeah. So Fritz, great question. And so the short answer to your question is no. Once you select either accrual or cash based, you cannot switch between the two. Okay. The reason being is because when it comes to time for the tax filings, if you're going off of the accrual-based system, you recognize the revenue at the time something occurred, not necessarily when you received the cash. With the cash-based, you recognize it at the time cash is received. So if you think about it, let's take this month for example. Let's say I made a hotel reservation for August 31st. Okay. My check-in is August 31st. My checkout is September 2nd. Okay. So I come into your hotel August 31st. I spent the two nights. I check out September 2nd. I recognized the revenue for August, okay, not for September. The reason being is because the service was delivered in August when the guest checked in, okay, and so but the customer didn't pay me till September. But the sale is recognized in the month of August, not the month of September. Does that make sense?
Yes. It does make sense. So any reservation that's made on the last day of the month, the revenue is not accounted for until they check out, regardless if it trickled over to the next month.
Correct. You got it. Yep. And so what happens is the major difference is when you look at your financial reports, that's where the biggest difference is. If you're using accrual based, you'll see that the financial reports will show that sale for August. It won't show up for September. Okay. If you're using cash based, it'll all be in September. It won't be in August. So that's where the difference comes into play, and that's the reason why the IRS requires that you select one or the other, and you cannot switch between the two. There are certain circumstances where you can show the reporting as either cash or accrual. You can switch the reporting, but you cannot. But when it comes to the end of the year, taxes being paid, it has to be either accrual or cash. It cannot be. You can't switch between the two. Does that make sense?
Yes.
Awesome. Great. Wonderful. We're on a roll. Okay. So with accrual-based accounting, the same concept applies with expenses. We record the expense at the time it's incurred, not necessarily when it's paid. So, for example, right now we're in the month of September. I'm going to get my electric bill on September 15th. I'm not going to pay it until October 2nd. Okay, so I recognize the electric bill for the month of September with accrual-based accounting. It's not being paid till October, but I'm recognizing the expense in September because that's when it happened. That's when the bill happened. So that's accrual-based accounting. Now let's take a look at cash. So cash-based accounting is when we recognize those revenues and those expenses when the cash is received or paid. That's why we call it cash-based accounting. This is most common with small businesses, like, for example, a catering business that you might own. Those types of businesses typically do use cash-based accounting, not just because it's easier, but that's for the service industry and for certain businesses, they opt for the cash-based accounting because they're everything they do is based on cash, right? So purchasing inventory, use cash. You're paying bills, use cash. You're not invoicing customers basically. If you're going to invoice customers, meaning, hey, you got 30 days to pay me. If you're going to invoice them, then you want to use accrual-based accounting. Because with that accrual-based accounting, you're basically saying, I'm recognizing the sale at the time the service was performed, but not necessarily when I got paid. Can anyone give me an example of a type of business that you think would use cash-based accounting?
Pop-up shops.
Yes, absolutely. A pop-up shop, no doubt. What else? What else do you think?
E-commerce stores like Amazon.
Maybe. So that depends. It depends. It depends on if they're sending out invoices. If they're not, then they might be using cash. Yeah.
What about Grubhub or Uber Eats?
I'm sorry.
Grubhub or Uber Eats?
Definitely cash. Absolutely.
Yeah, I said, yeah, like Lyft and food, like food trucks. Like
Yes,
food,
definitely
like
cash. Absolutely.
cash, yeah.
What about those people that do this to my hair that I don't have much of?
Barbershop.
Barbershop. Definitely
Mm-hmm.
cash business. Absolutely.
I didn't want to say that.
Oh, wait a minute. The nail shops. Wait a minute, Professor. The nail shops are right now cash business because a lot of them want cash. They don't want
That's
to
right.
do cards. A lot of them would rather you to have cash on them. I went to a couple of them and I'm like, y'all use cards? Like, no, we prefer cash. I'm like, wow. So a lot of things have transpired over the cash.
Yeah, so there's another difference between like physical cash and using a card. A card and cash are the same exact thing. Okay, so in accounting, they're the same exact thing, right? Either way, you're paying that for that service or for those goods. So whether you're using physical cash, like cash paper money, or you're swiping that card, they're both recognized as cash, right? Because you're still paying for that good or that service. The reason why some businesses don't like using the cards is because they have to pay a transaction fee to those card companies. So every time that the business swipes that card, the business has to pay 3% or 5% of the sale price for processing that card. That's why businesses don't like to use.
Can I ask your question real quick? So that means, because I was wondering with this courier I went to, she charged me, well, they want you to spend a certain amount, but then they charge you an extra 50 cents on top of that amount. And I was wondering, everybody was asking, like, what's that fee for? Like, why are you charging us that fee?
Yeah.
You know, even if you go into a regular store and you use your card and you don't spend a certain amount, they charge you a fee for
That's
not
right.
spending a certain amount on that card.
That's right. Yep. And that's because that vendor or that person who's selling you the product or the service, they have to pay a transaction service fee to the credit card company. So they're just passing that along to you. That's what they're doing.
So Target and Walmart will be considered a cash base.
Oh, good question. They probably used accrual-based accounting, and the reason being is because when Target or Walmart purchases their inventory from their suppliers, they're probably not paying them right away. They're probably waiting, 15 or 30 days or whatever it is to pay them.
Okay.
So they're probably using accrual.
So I actually was helping out a friend who was trying to get some of her products. It's a Haitian brand tonic for hair growth, and she was trying to get a Walmart or two in Miami to hold her product. But they agreed it did well enough on her online page. But they were trying to give out a contract. Did you have to sign a contract before you can even put your product, or they sell any of your product? And one of the fine printing, it was saying that she won't get her money until 30 to 90 days after her products are sold because of whatever system they have. So that's crazy. I would never put a product at Walmart.
Yep. Yeah, that's how Walmart operates. And so to answer your question based off of that, yes, it's accrual based for Walmart, because that's how they operate, and that's how they're able to keep prices as low as they are, because they usually end up having, after the sale is made, if they're not paying you until 90 days later, what do you think that money's doing while it's sitting in the bank? It's accruing interest, right? So
Right.
that's one of their tactics. Interesting. Yeah, and we're going to come across a lot of that type of stuff. Okay, so let's talk about the revenue and expense recognition principle. This is one of the primary principles of accounting and of business, of course. Revenue recognition principle, basically all this tells us is that we recognize the revenue, which is from the sale of the inventory or that service. We recognize that either at the time of the service, that's the accrual, right? Or the time the cash is received. And so that's the revenue recognition principle. Again, with accrual based, if I make the sale in September, but I don't get the cash until October, I recognize my revenue in September, because that's when the transaction happened, right? In cash based, with that same example, I would recognize my revenue in October, because that's when I received cash. That's the revenue recognition principle. It's basically saying I recognize my revenue when the good or the service is delivered to their customers, based off of the accrual-based accounting system. And I might recognize revenue at the time I receive cash if I'm using the cash basis. That's all this tells us. But it's important that you know with this principle what month you're recording that revenue in, based off of what system.
Professor.
Yeah. Yes.
So you're saying subscription monthly bills are all accrual-based accounting.
That's
like your
correct.
light bill, your gas bill, your subscription for Netflix, all of that is a form of accrued accounting.
That's correct.
Basic. Oh, okay. Okay.
Yep, because that company, you know, the electric company or the Netflix service or whatever, those companies recognize their revenue at the time that you are using their electric, right? And so they'll bill you based off of usage. So they're billing you for that month that you used that electric, right? They recognize the revenue then. They don't recognize it the following month when you actually pay it. So, good question. Yep, so that's revenue recognition. And then, of course, if we're talking about revenue, got to talk about expenses, right? So, as we talked about with accrual-based accounting, we recognize the expense at the time that we incurred that expense, right? Just like the electric bill. I got my electric bill in September. It was for the month of September, or you know that 30 days or whatever it was, right? I'm not going to pay it until October, but I still need to recognize that expense in September because it happened in September. So this is also called the matching principle. I'm matching my revenue and my expenses based on the period that it actually happened in. That's called the matching principle. I'm matching my revenue and my expenses in the period of which it actually happened. So when you look at your income statement, as you know, with income statements, you can generate those monthly, semi-monthly, semi-annual, and annual. Those are the periods, right? I personally, for my businesses, I always look at the income statement every month, okay? The reason why I look at it monthly is because I want to make sure that whatever revenue and whatever expenses I incurred during that month show up on the income statement for that month. That's the concept of matching. Now, once in a while, we need to make adjustments to properly match these revenues and expenses. And let's talk about the adjusting process, and then I'll give some examples. So the adjusting process, at the end of the accounting period, like at the end of, we'll say August, okay, an adjusted trial balance is prepared to verify that the total debit balances equal the credit balances. Well, of course, they're going to balance because as you're making the journal entries, there's a debit and a credit for every journal entry that you make. Those two must always be in balance. There might be an instance where you need to make an adjustment at the end of that month. An example, insurance. Okay, insurance. Let's say for your car insurance, you pay your car insurance every 6 months, okay? And that insurance covers that next 6 months, right? When you make the payment, it covers 6 months forward, right? You're not paying for what you already used, you're going to pay what you will use. That's called a prepaid expense, right? And so when you prepay your insurance, it's a prepaid expense. And eventually you'll recognize that expense as you use it. So let's say you prepaid 6 months of your car insurance. 3 months goes by and something happens to your car, okay? And so you no longer need that insurance, so you'll make an adjusting entry to recognize the 3 months of insurance expense that you used and the rest will be cleared out, right? And that's an example of an adjusting entry. How does that look on a monthly basis? So to pay to make an adjusting to the original entry, you would debit prepaid insurance and credit cash to show that you've made the payment for the 6 months of your car insurance. At the end of every single month, you'll debit insurance expense and you'll credit prepaid insurance. You'll debit insurance expense and you'll credit prepaid insurance. That shows that we're moving the expense from prepaid to the actual expense. Does that make sense? Or did I lose anyone in that example?
Yes.
Awesome, thank you.
Professor, I have a question about adjusting. I can't see. There's something blocking the process. Okay. And you gave an example of car insurance, right?
Uh-huh.
So how does that? To me, I feel like it's basic, but it sometimes can come off predatory. And I do notice that when you're trying to, let's just say you're trying to file a claim, and the money you paid to your car insurance, let's just say you paid the full term 6 months in advance, and you get into a car accident, and then you're trying to go through the process of getting your car fixed or whatever the situation is, right? How oftentimes they will make it seem like you didn't pay them enough for the cover costs that you service providing to you, and I think that's very predatory.
Yeah. From that perspective, it kind of is. You know, when it's kind of, unfortunately, that's oftentimes the way insurance companies work. The idea behind insurance is that in the event that something happens, they'll cover the cost, right? You pay a little bit, you know, or however much it is per month or per year or whatever. You pay into it. You expect to get more out of it when you need to use it, right? It's supposed to cover all of the expenses. Some car insurance companies, depending on the type of coverage that you have, they get all kinds of, like you said, it almost seems like it's predatory. In some cases, it probably is. So that's why I personally hate insurance, but you know, we all have to use it at some point. So yeah, from that perspective, you know, trying to get some back, it's difficult, and it's a long process. When it comes to recording the transaction, that's why you think of it this way. You prepaid it, right? The first transaction was you prepaid the insurance. The second transaction, which is the adjusting entry, is that as you use it, you adjust what you used. You take what you used, and you record that as your expense. So think of it as you use it. That's the adjusting part. So you prepay it in the beginning, and then you ultimately will use it. As you use it, you're recording an adjusting entry for the use of that prepayment. Let's see. Here's another example. Rent is another example of this. So when you pay your rent or your mortgage, when you make that payment to the company recognizes that as unearned revenue because it hasn't happened yet. When it happens, then it becomes earned revenue. The same concept applies with the expense. You pay your rent before the rent's due, obviously, right? Before the month happens. So, like, for example, I'm going to pay my landlord on the 20th for the month of October. And when I pay her the rent check for October, on her books, it's unearned revenue. On my books, it's a prepaid expense. But when I incur that expense, I then make an adjusting entry. When the month happens, I then make the adjusting entry. Does it make sense? Good so far?
Okay. Okay.
Awesome. Okay. We're getting there.
I'll take my quiz over again.
well, hey, the good news is I think you could do it up to 2 times. So, you know.
I already did it twice.
Oh, no.
Nah, it's cool. Go ahead, man.
Oh, goodness. Okay. So what else can I tell you about this? I told you about the adjusting entries. Yeah, that's a concept of making adjusting entries. It's when you make adjusting entries, it's because you have used the prepayment of whatever it was. That's the typical reason. Sometimes other reasons to make adjusting entries, but the most common ones are because you prepaid something and you're using it. You're recognizing that expense. When you recognize that expense, that's when we use the adjusting entry. It's kind of like prepaid insurance becomes insurance expense when that month happens for that prepayment. That's the concept behind it. Okay, let's see. 2 classifications for accounts requiring adjustments are called accruals and deferrals. An accrual occurs when the revenue has been earned or the expenses has been incurred but not yet recorded. So that's what I was just talking about. Taking it from a prepaid insurance to an insurance expense. That's through the accrual process by which I prepaid it. It was a prepaid, which was a liability. It becomes an expense when that insurance is realized. And I record it through the adjusting entry. Sometimes it'll happen for revenue. If it's unearned revenue, it becomes earned revenue. Unearned revenue means the customer paid me a deposit or the customer paid me in advance of me actually performing the job. That's when it becomes unearned revenue. It becomes earned revenue when you do the job, when you deliver the product or the service. And so we make an adjusting entry to, we'll debit revenue and we'll credit unearned revenue in order to recognize that revenue. The same could be said with accounts receivable and accounts payable. Accounts receivable is when I generated a bill, I sent it to my customer has not yet paid. That bill generation, that is what we call an accounts receivable. Means I've done the job or I've provided the service or I delivered the good, but the customer hasn't paid me yet. That generates what we call an accounts receivable. When the customer pays me, I reduce my accounts receivable and increase my cash.
So when we pay, Professor, so when we pay our bills, it's set up as an account receivable for the company, such as the light bill.
That's right. Yep.
And then we get a receipt that indicates the transaction has been, this good and services have been paid for.
That's correct. Yeah. So going back to our electric bill example, the electric company generates an increase their accounts receivable at the time that they send you the bill. When you pay that bill, the company reduces their accounts receivable and increases their cash. Think of accounts receivable and accounts payable. We call these contraflow accounts. Contraflow accounts. Accounts receivable and accounts payable are contraflow accounts. What does this mean? It goes up and down depending on the transactions that occur. Accounts receivable goes up when I send the bill to my customer. Accounts receivable goes down when I receive cash from my customer for that bill. The opposite is true for accounts payable. Accounts payable means I got a bill from the electric company. I haven't paid it yet. When I get my bill from the electric company, I increase my accounts payable. Okay. So how do I do that? I debit my utilities expense and I credit accounts payable to increase my accounts payable. Okay. When I pay the electric bill, I debit accounts payable and I credit cash. That's the second entry. So remember, accounts receivable and accounts payable, they're contraflow accounts. Think of them as like the intermediary accounts. They act as an area where you're waiting to receive cash from your customers. That's accounts receivable. Or an area where you're waiting to pay a bill. That's accounts payable. For something that's already happened. Does it make sense so far?
So I just want to make sure I understand. Account payable is something in which you know there's a services that you're going to have to pay for, and the account receivable is when you already receive a service and you have it's a notice or invoice to let you know that you have to pay for that service that you just used.
Yeah, from the customer side, that's correct. From the business side, if I invoice my customer, if I said, hey, listen, I sent you what you bought, you haven't paid me yet, so I send you an invoice. That for the company, that's an accounts receivable, meaning I expect to receive payment for that sale. Okay. Accounts payable is saying I'm the company. I received a bill from the electric company for the utilities. I haven't paid the bill yet, so therefore I expect to pay the bill for the utilities. So that's accounts payable. Does this make sense? You got to think of it from the business perspective, not the individual perspective. Yeah. Okay, good. We're on a roll. Okay, here's how it looks. This is why I really like these slides. Accrued revenue. Accrued revenue. Okay. The accrued revenue means it's a prepaid revenue, deposit a customer made. Okay, customer made a deposit. It's unearned revenue. It becomes earned revenue when the service happens. In this first example, revenue has been earned. We don't have to worry about making an entry when we earn it. We do have to make an adjusting entry. The adjusting entry is we debit our accounts receivable, okay, to increase our accounts receivable, and we also recognize our revenue. We credit our revenue to increase our revenue. Now, in most cases, under your assets are what? What are examples of assets? You guys learned this in chapter 2, I think. Chapter 1 and 2. I'm sorry.
Property.
Property. Yep. What else? What's that?
A vehicle.
I'm sorry.
A vehicle.
Vehicle. Yes. What else?
Actual cash that one owns.
Actual cash. That's an asset, most definitely. What about accounts receivable? Is that an asset?
That's money coming in.
That's money coming in. That sure is an asset. Absolutely. So with our assets that include cash, accounts receivable, property, plant, equipment, anything along those lines, those are all assets, okay? When we increase our assets, we make a debit through that account. When we increase an asset, we debit the account. When we decrease an asset, we credit the account. And I could hear you already. Dr. B, what about revenue? Revenue is technically an equity account. It's technically an equity account. What's equity? Equity is the difference between your assets and your liabilities. Okay? Equity is what the business owns, essentially, right? The business makes a sale, the business owns that sale. That's equity. Okay? So this entry here, we're debiting an asset account, accounts receivable, and we're crediting an equity account, revenue. Revenue, as you know, is sales, right? So on the balance sheet, assets equals liabilities plus equity, the two are still in balance. That equation is still in balance, okay? Let's look at this accrued expense. The expense has been incurred, meaning the expense happened. I got my electric bill, okay? I got my electric bill. I increased my expense by debiting my expense, okay? I increase my expense by debiting my expense. I debit utilities or electric, whatever it's called in your chart of accounts. Most times it's like utilities expense. I debit my utilities expense for the electric bill, and I credit my accounts payable, meaning I haven't paid that electric bill yet. I just got it in. I'm going to enter it into my system as a utilities expense, and I'm going to enter the bill in, accounts payable, and I credit accounts payable to increase my payable. Now, let me ask you, what category is accounts payable? Is that assets, liability, or equity?
Liability.
It's a liability, yeah, because it's something I owe to someone else. I owe them money. So it's a liability for me. So the entry I would make when I pay that electric bill, I would then debit accounts payable to reduce it, and I would credit my cash because I'm paying it in cash. Make sense so far? Good.
Yes.
Okay.
Yes.
All right, we're on a roll. We're doing well. So, okay, deferral. A deferral means deferral's like saying unearned. Okay, deferral means unearned. The word deferral isn't used all that commonly. Your book likes to use it. I don't like to use it. But deferral means unearned. Deferral. I'm deferring it. I'm deferring it. It's unearned. Okay. Deferral occurs when it's related to a future revenue or expense. I'm deferring it to the future. Or it was initially recorded as a liability or an asset, meaning it's unearned. When I receive cash for something that I have not yet performed the service or sent the inventory, it's unearned revenue. It becomes earned through the adjusting entry when the service or the good has been sent. And then, of course, prepaid, we talked about that. A prepaid insurance means I'm paying for my insurance for future months. The expense has not yet happened, but I'm paying them before it happens. Okay? And then the adjusting entry would be to adjust for the recognition of that expense. So here's how that looks. let's take a look. The initial record for unearned revenue. I received cash from my customer I received a deposit from my customer for a wedding that has not yet happened. I increased my cash by debiting my cash, and I increased my unearned revenue by crediting the unearned revenue account. Is unearned revenue a asset or liability? What do you think?
It is a liability.
Liability.
Okay, so I'm getting a little bit of both. Unearned revenue is a liability. Unearned is the key word there. Unearned revenue is a liability. The reason why it's a liability is because it's not yet earned. It's technically not a sale yet, right? It becomes an asset when it becomes a sale. But until then, it's a liability. Because what can happen, right? Okay, so let's go back to my wedding example. I received the cash from the bridal party. The wedding hasn't happened yet, so it's unearned revenue. Let's say they cancel, okay? Well, it's difficult to decrease the asset, right? So that's what makes it a liability. It hasn't happened yet. So if it hasn't happened yet, it's a liability. So unearned revenue is a liability. That's correct. Now, when I make the adjustment, let's say the wedding goes on as planned. Great, awesome, cool. So the adjusting entry is I debit unearned revenue and I credit revenue to recognize the revenue that has happened. Make sense? Good. Okay, good. Prepaid expense, going back to the prepaid insurance expense, I debit prepaid expense, or prepaid insurance expense in this example, and I credit cash because I'm paying the insurance company for the 6 months of insurance that has not yet happened. At the end of each month, I'm going to recognize that I've consumed that insurance, okay? Consumed it. Meaning I can't get it back. If the month is over, I didn't use the insurance, but I consumed it, okay? So the adjusting entry here is I debit the insurance expense account and I credit the prepaid insurance expense account to recognize the consumption of that prepayment. Okay, so let's look at this real quick. The unadjusted trial balance. With a trial balance, we are making sure that our debits equal our credits. We are looking at all of the accounts that have been impacted by those transactions. We are making sure that our debits equal our credits. Because remember, in accounting, the two must always equal. So we're not going to get too far into that because it gets pretty deep from there, and that's more of a 202 type of discussion. Well, let's take a look at the chart of accounts. Just like we talked about with assets, we got cash, accounts receivable, supplies, which is also more commonly called inventory. Inventory is supplies. Your book likes to call it supplies. I call it inventory. It's the same thing. Prepaid insurance, land, office equipment, accumulated depreciation. You're probably saying, Dr. B, why is prepaid insurance an asset? That's cash that you technically still use for something that will become an expense. Okay, so let's say the 6 months worth of car insurance, I paid it out. The 6 months hasn't happened yet. To me, it's still an asset. The reason why is because I could cancel that policy and get that cash back. Or I'll decrease the prepaid insurance account as I use it, and then it becomes an expense, right? Liabilities. Liabilities are anything the company owes to someone else. These would be things like accounts payable, wages payable, unearned rent. What is wages payable? What is that? What do you think?
Paying your workers.
That's right. It's paying your workers. You haven't paid them yet. So think of it this way. Your employee works for you. You pay them every 2 weeks. You pay them based off of the hours that they worked, right? So at the end of that 2 weeks, another 2 weeks goes by, then you pay them for that previous 2 weeks. That's why they always say, oh, payroll's always 2 weeks behind, right? The reason for that is because of the taxes and all that jazz that need to happen to the payroll. So 2 weeks, you owe the employee for the 2 weeks that they worked. Therefore, you have a wages payable for the amount that you owe the employee that they worked, but you have not yet paid them. That's a wages payable. It's very similar to accounts payable. Very, very similar. The reason why sometimes we'll categorize them differently, accounts payable versus wages payable, is because with wages payable, we're typically dealing with payroll taxes. And then sometimes you'll also see one that'll say taxes payable would be another one. There's a lot of possibilities there. Other liabilities, unearned rent. There's more than that, right? There's loans. So like if you have a mortgage, the mortgage is a liability, right? If you have student loans, the student loans are a liability. If you have any other type of loan, a car loan, the car loan is a liability. It's a liability because you owe it to someone else, right? So anything that you owe to someone else is a liability. Anything that you own is an asset. And then equity is the difference. What is equity? It is common stock, preferred stock, retained earnings, dividends. These are things the company owns, things that belong to the company. It could also be like initial investments from owners, things like that. Revenue, there's earned revenue. There's a lot of different types of revenue. Fees earned. Fees are for like lawyers, attorneys, accountants, doctors, dentists. Those are all service businesses, and so they recognize fees earned. Fees earned. For somebody who sells inventory, it would be revenue from sales or sales revenue. For a company, for somebody who owns like real estate and they rent real estate out, rent revenue would be on their list. And of course, there's expenses. There's a lot more than this. There's a ton of different expenses, but just a few: wages, supplies, rent, utilities, insurance, depreciation, miscellaneous. The list goes on. And you can get as detailed as you want with your chart of accounts. But every business has a chart of accounts. Every business uses similar names for their accounts. So this is just a basic example. This is another example of accrued revenue. So in this example, the company signed a contract to provide service at $20 per hour. At 25 hours, the revenue will be billed on January 15th. So the company recognizes the receivable and the fees earned, $500. How does it look on your chart of the impact of your equation? The accounts receivable, as you know, is an asset, so we increase our asset by 500. The Sales, which is a part of equity, is 500 and picks your stockholders' equity. So as you know, 500 equals 500. The accounting equation is still in balance. Okay. This is what it looks like on your income statement. I made the sale $500 minus any expenses gets me to my net income. The net income shows up on the balance sheet under equity. Net income transfers to equity. That's also known as retained earnings, is what it would go to. The revenue, $500, that was cash. So the cash gets added to the assets, $500. So your balance sheet, the way your balance sheet is set up, as you know, is assets equals liabilities plus equity. The left side of your balance sheet is your assets. The right side of your balance sheet is your liabilities and your equity. Assets equals liabilities plus equity. The accounting equation will always be in balance, and it shows up on your balance sheet. Let's see. Same concept with the expenses, wages. Talked a lot about those matching principles. Let's see. Talked about unearned revenues a lot. These examples are pretty good. I like them. It just kind of gives you like a visual representation. Okay, covered all the important stuff. Come on. Okay, depreciation. Depreciation. Let's talk about depreciation. Okay, let's talk about things that depreciate. Physical things depreciate in value over the life of that asset. Your car, for example. Your car depreciates over time. Okay, they all do. I promise you, they all do. Cars depreciate over time. Equipment depreciates over time. Buildings depreciate over time. That's why property, plant, and equipment depreciate over time. What is depreciation? This means the value of that property, plant, or equipment decreases over the useful life of that property, plant, or equipment. For example, I have a dump truck. The dump truck cost $25,000. I bought it for $25,000. Okay. The dump truck is expected to last me for 5 years. Which means over that 5 years, I will depreciate the value of that dump truck until it reaches a value of 0. Bought it for $25,000. I'm going to spread that over the 5 years. So every year, my depreciation expense for that dump truck is $5,000 until it reaches a value of 0 at the end of its useful life. And I'm sure there's probably more examples I can show you. As time passes, the property, plant, and equipment, like a dump truck, for example, loses its ability to provide usefulness to the service. Therefore, we decreased its usefulness. We call that depreciation. That's the technical way of thinking about it. All fixed assets, except for land, use usefulness and value, so therefore we depreciate them. Land never depreciates. Land never depreciates. The reason why land doesn't depreciate is because we look at land as being a infinite asset. Infinite. Meaning I can keep reusing the land. The building, on the other hand, I can demolish that and put another building up. I can put another factory up. I can demolish that, put another factory. I can demolish the house, put another house up. But the land does not depreciate because that piece of land will always be there. We call it infinite. That's why we don't depreciate land. But everything else, yeah, we can depreciate that. when you record it, depreciation, we record it periodically. It's a periodic expense. Usually at the end of every single year, we record depreciation. Sometimes at the end of every quarter. It depends on how you file your taxes, but I typically do mine at the end of every year. Okay, depreciation requires an adjusting entry because it doesn't have to, it has nothing to do with actual cash. Depreciation has nothing to do with actual cash, okay? Depreciation represents the devaluation of our assets over time. Our property, plant, and equipment, that is. And so we increase depreciation by debiting. The depreciation expense, it goes up until the point it reaches a value of 0, which means we reduce the amount of our fixed asset by crediting it. So we debit depreciation expense, we credit the fixed asset. That's our property, plant, and equipment. Until the value reaches 0. That's because we depreciate property, plant, and equipment. Okay. Accumulated depreciation, these are also known as contra accounts, very similar to accounts payable and receivable. We use accumulated depreciation if we record depreciation on a monthly basis. Some businesses don't. I typically don't. I don't like to do that much work. Let's see. So again, property, plant, and equipment are things that receive depreciation. Land does not. Land does not get depreciated. Here's an example. We have office equipment. We'll say it's a computer. And we depreciated that computer by $50 for the month of December. We bought the computer for $1,800. We depreciated it $50 per year or $50 per month, and so accumulated depreciation for that computer is $50 for December. And our depreciation expense is $50 for December. It's just one of many examples. And of course, there's always what we call book value. The book value is the difference between the original cost of the computer that I bought for $1,800 and whatever it's worth currently. I call that book value. So if I bought the computer for $1,800, in the month of December, I accumulated $50 in depreciation. Therefore, the computer is now worth $1,750. So original cost, $1,800 minus any depreciation of that asset. So minus $50, $1,750. That's just one of many examples. And here's how that looks on your income statement, balance sheet, statement of cash flow, or income statement and balance sheet. Our expenses that is our depreciation expense, $50. Our assets get depreciated by $50, and our equity increases by $50. So therefore, the accounting equation is always in balance. There's so many different examples of depreciation. And I'll leave it to you all to read through some of those. I'm just trying to highlight the most, what I think are probably the most important items. Okay, we're getting down. Okay, adjusted trial balance. An adjusted trial balance is something that we develop to ensure that our debits and credits equal, right? Here's what that looks like. I line up my debits and my credits with all of the various accounts that I've impacted throughout that year. And as long as my debits and credits balance, I can make, based off of any adjustments that I've made throughout the year, we call this the adjusted trial balance. We do the adjusted trial balance after we have made adjustments for things like depreciation or unearned revenue or prepaid insurances, things like that. Vertical analysis. Okay, this is a good topic. I like this one. When we compare our financial statements from month to month or year to year, we're comparing the total amounts and the changes that have incurred from year to year. We do that through what we call a vertical analysis. Vertical. We look at things as a percentage of our balance sheet, our income statement. On our income statement, we look at everything, every line item as a percentage of total revenue. On our balance sheet, we look at everything as a percentage of total assets. And that percentage tells me how effective that asset is, or how effective I am at managing my expenses. That's the concept behind vertical analysis. It's really useful for those who are managing or trying to manage how effective their assets are at generating revenue, and also to understand how effective they are at managing their expenses by using this vertical analysis. Here's what it looks like. On your income statement, you have your revenue and your expenses, and then your net income. We look at everything expressed as a total of total revenue. So total revenue is 100%. Of that 100%, my wages and expenses were 32%. My rent expense was 8%, 6.7 for utilities, 1.4 for supplies, 1.2 for miscellaneous. So when you look at all of this, your 49.3 plus your 50.7 equal 100%. The reason why you want to run this type of analysis is to kind of show you how effectively you're managing your expenses. 32% for wages is kind of high. And it looks like it went up from year one. In year one, it was 30%. Year two, it's 32%. So maybe I have some overtime in there. And so what does that tell me? It means I need to be more effective when it comes to managing my overall wage expense. That's kind of the basic premise behind vertical analysis. Okay. We made it to the end of chapter 3. Any questions so far? Chapter 3. We're good? You're all still there, right?
No questions.
I haven't put you.
Yeah,
Yeah,
I haven't put you guys to sleep, have I?
no.
I know how exciting this is. Some of you are like, man, this guy just keeps talking. I'm just like, oh man, is this guy gonna ever stop? I don't know.
No, you're fine.
Okay, all right, good.
I'm just taking notes, that's all.
Okay, good. Again, if you have questions, just bring them up. I'll be happy to answer them. Okay, so that's chapter 3.
I got a question. When you gonna post this recording? Because my son got logged back into school.
That's
in
fine.
one
I
minute,
plan to
so
post it as soon as it becomes available. What does that mean? Probably in a few hours.
okay, all right, cool, all right.
It might be tomorrow. It depends on how quick WebEx is, and WebEx kind of, it's not the best. So, hopefully in a couple hours.
So you'll send out an email though, right?
Absolutely.
All right.
Yeah.
Okay.
I got you. It's
All right,
okay.
Professor.
I know you got family to take care of. I totally understand.
All right. You have a good one.
All right, you too. Take care.
Uh,
All right, chapter 4. This is completing the accounting cycle. As you know, the accounting cycle has several steps involved. We went through all of those steps. Now let's talk about the whole thing together. We're going to complete the accounting cycle. We talked about adjusted trial balances. We talked about recording the expenses. We talked about the whole concept. So now let's put it all together. We look at the income statement. As you know, the income statement has your revenues, your expenses, your net income. And of course, we got to make sure everything is in place based off of the matching principle, things like this. The expenses and the income statement are listed in order of size. I guess so. They don't have to be. I usually list them out by in alphabetical order. But I guess when you're comparing things, we look at them in size. Miscellaneous expense is typically the last item, regardless of the amount. That's correct. That's typically where it shows in your chart of accounts. Miscellaneous expense is always the last one. Why is it the last one? Because we don't know what's in it. I personally do not use miscellaneous expense. I try to avoid it at all costs. Sometimes you have to, because you just don't know what the expense was. But for me, I don't like miscellaneous expense. It usually concerns me when I see a large amount in miscellaneous expense. It's kind of like a catch-all for something that you don't have a place for it, right? I personally try not to use it, but that's just me. Word miscellaneous scares me, especially when we're talking about accounting. It scares the crap out of me. So I am a very straightforward kind of guy. I like things very clearly identified. When I see miscellaneous, it makes me nervous. Could mean anything, right? Retained earnings statement. This is the fourth of the large financial accounting statements, right? You have your income statement, your balance sheet, your statement of cash flows, and your retained earnings statement. Retained earnings, as you know, is what's left over at the end of the year. And we're going to keep that money in the business. We're going to keep those earnings in the business. That's why we call it retained earnings. We're retaining the earnings in the business. Okay, that's why we call it retained earnings. So on December 31st, I'm closing out my books for the previous year. I have earnings. I'm going to keep it in the business. It goes to my retained earnings statement. Okay. There might be a beginning balance of retained earnings from the previous year before, or it might be zero if it's a brand new company. If it's money from the year before, we add or subtract if there's losses from the retained earnings from the beginning of that period to get us to our net retained earnings. Let's see, is there an example? I'm sure there's, I know the book has an example on it. But we really don't do a whole heck of a lot with the retained earnings statement. We only really touch it at the end of the accounting cycle. So we closed out the year, we then impact the retained earnings statement. But that's really the only time we deal with it. We don't touch the retained earnings throughout the year. We only touch it at the end of every single year. The balance sheet, as you know, the balance sheet has assets, liabilities, and equity. The balance sheet is prepared directly from the adjusted trial balance at the end of the period, beginning with its cash. They say spreadsheet. I don't use Excel spreadsheets anymore. That's kind of like the old school way of doing things. I use like QuickBooks or other accounting softwares to make it a lot easier. The asset and liability amounts are taken from that information. The retained earnings amount is taken from retained earnings statement. This basically kind of, all it does is it shows you how all these things are connected, right? The balance sheet shows the subsections of assets, liabilities classified in balance sheet. Again, you have your assets, current and long-term, and you have liabilities, current and long-term. What is current? What does that mean? Who can tell me what is current? What does it mean to be current in accounting?
Do it mean recent?
Yes, it does. It does mean recent, absolutely.
Okay.
And we also have long-term. What is long-term?
Over time, basically.
Yeah, exactly.
I guess.
So here's the formal way of thinking about it. Current means 0 to 12 months. Current is 0 to 12 months. Anything within 1 year is current. 13 months and greater is long term. Current is 12 months. Within the next 12 months, that's current. Greater than 12 months is long term. Does it make sense? So current is less than 12 months. That's current. Anything over 12 months, greater than 12 months, is long term. It's one way of thinking about it. Does it make sense?
Yes.
Awesome. So with your assets, you have current assets and long-term assets. Current assets are things like cash and accounts receivable. Cash and accounts receivable and inventory are current assets. Those are things you can quickly turn into cash. Those are current. Okay. So with your assets, anything that you can quickly turn into cash is current. So that would be cash, accounts receivable, and inventory. Long-term assets include things like property, plant, and equipment. It's difficult to turn property, plant, and equipment into cash quickly. Therefore, we consider them to be long-term assets. Property, plant, and equipment, those are long-term assets. Liabilities also have current and long-term. A current liability would be accounts payable, wages payable, prepaid insurance, or I'm sorry, prepaid expenses, right? Or unearned revenue. Those are all current liabilities. They happen within 12 months or less. Long-term liabilities are things that take longer than 12 months to pay. Like a mortgage is a long-term liability. A car loan, long-term liability. Student loans, long-term liability. Because they take longer than 12 months to pay. The life of the loan is greater than 12 months, therefore it is long-term. Does it make sense? Now, there's also what we call the current portion of long-term. A current portion of long-term means, let's say I have a car loan for 5 years. The current portion of that car loan is that first year. Is that first year that I'm paying off. That's the current portion of a long-term loan. It gets a little dicey, but that's as crazy as it gets, I promise, when it comes to that. We're good so far? Yes? Okay. How do I get out of this annotation?
Sorry.
No, that's okay. You're fine. You're fine. Okay. Current assets, again. Anything that could be quickly converted to cash, we call it a current asset, or it can be used within 1 year. So that's cash, notes receivable, accounts receivable, supplies, which is also known as inventory, and other prepaid expenses. Those are things I can utilize within 1 year. Notes receivable, this is kind of rare. Notes receivable, it's like when you give a customer a loan and the customer is going to pay you back the loan plus interest, that's a notes receivable. It's kind of like a line of credit for your customer. That's a notes receivable. It's kind of like, you know how you like to use your Macy's card when you go shopping? Macy's recognizes the Macy's card as a notes receivable because you're the customer, you received a line of credit, you're going to pay Macy's back the what you used on the card, so therefore it's a notes receivable to Macy's. That's an example. And of course, the long-term stuff is property, plant, and equipment. Those are things that can be used over a long period of time. Current liabilities, these are things that I owe to my creditors in 1 year or less. That would be notes payable, accounts payable, wages payable, interest payable, taxes payable, unearned fees, or unearned revenue. Long-term liabilities, these are things like a mortgage, a car note, you name it, anything that's long-term. Stockholders' equity, this is what the business owns. This is the rights to the assets of the business. This is what the business owns. These are like things like retained earnings is a component of stockholders' equity. This is what the business owns. It's basically, think of it as the difference between assets and liabilities. Permanent accounts versus real accounts. Permanent accounts means from year to year it's called the same thing. The name doesn't change. A permanent account would be things like cash, accounts receivable, accounts payable. Those are permanent accounts. They'll always be there every year. And there's a balance that's carried forward every year. Real accounts, it's pretty much the same thing as a permanent account. Permanent is real, I guess. There's temporary accounts. These are things that we close out at the end of every single year. Like all of our expenses, those are technically temporary accounts because we close them out at the end of every single year. Pretty much anything on the income statement is a temporary account. Okay. As we close our books at the end of every single year, we go through a closing process and we make closing entries. These are adjusting entries, right? To achieve this, temporary account balances are transferred to permanent accounts, meaning everything on my income statement at the end of the year gets transferred into retained earnings, which ultimately is on the balance sheet. So at the beginning, when I begin the next year, I begin with zero balances on my expenses and on my revenue. It's basically like kind of resetting yourself, resetting the book every single year. To do that, we take all of our revenue and expenses, we transfer them to the retained earnings account, which is on the balance sheet. That's the process of closing your books, as we say. And the process is 4 steps. So again, we transfer the revenue to income summary, which is technically we transfer our expenses to income summary. Income summary is transferred to retained earnings. And then of course we subtract out any dividends that we pay out. Income summary is a temporary account that we use during the closing process. All it is basically we take our revenue and our expenses, we put them into this account summary category, and then eventually that gets transferred into retained earnings after any dividends get paid. What else can I tell you about that? It's also called a clearing account because eventually you get we transferred the income summary to retained earnings, so we call it a clearing account. We clear it. We clear income summary and we transfer everything to retained earnings. So you might hear it called that as well. Okay, so closing entries. To do this, we debit the revenue accounts and we credit the income summary. We credit our expenses and we debit our income summary. and we transfer our income summary to our retained earnings by debiting the retained earnings account. Yeah, pretty straightforward. Post-closing trial balance. This is something that we do at the end of every close to ensure that all of our ledger has been cleared for the next year. That's why you hear accountants going crazy at the end of every single year, because the process it takes a lot of time. So the accounting cycle, what is it? It's what we just went through for the past 3 chapters. So it starts with analyzing journalizing transactions, and it ends with post-closing. This whole process, basically it's like 7 steps that we just went through. It's called the accounting cycle. That's the name of it. Or 10 steps, I guess. This is kind of expanded. So the 10 steps, the first thing you learned about in chapters 1 and 2, you learned how to analyze and record general journals or transactions. The transactions are posted to your ledger. That's basically like the recording of the transaction, right? We look at the unadjusted trial balance. We make adjustments where we need to through adjusting entries. We might do an end of period spreadsheet. I never do. It takes too long. It's kind of pointless. Step 6, analyzing entries are journalized, posted to the general ledger. Step 7, adjusted trial balance prepared. Step 8, financial statements are prepared. Step 9, we close out our entries, and we close it out through the closing process. That's the accounting cycle in a 10-step process. What is a fiscal year? Oh, okay, so you know what a calendar year is, right? We start in January, we end in December. What's a fiscal year?
Isn't a fiscal year? It's like some accountings, like they're when the accounting closes for the year. So like some companies, they close like in December, where they close the whole system down before Christmas. And some companies, they close in November.
That's right.
Because it depends on like the company, like which new year they follow. Like most Americans, we follow that New Year's is December 31st through the 1st. So you close before Christmas. But certain countries, like internationally, I think they close in like October or November, because that's where their New Year's begin.
Yeah, exactly right. So with a fiscal year, and if you look at our government, right, the federal government, their fiscal year ends in I think end of September, and their fiscal year begins the first day of October. So they don't follow the normal calendar, if you will. It depends on when the business decides to have their 12 months. Like when I had my business, my fiscal year started on April 1st and it ended March 31st. That was just the natural progression that my business made over the first 12 months of operation. And so that's how I established my fiscal year. So the fiscal year begins with the first day of a month, and it ends with the last day of that end of that 12 months, that 12-month cycle, whatever that is. Not all businesses follow the same fiscal year cycle. Some businesses start their year April 1st, some start it in September, some start it in January. It doesn't matter. It doesn't. It's whatever full 12 months there is. That's the fiscal year. But it'll be the same every single year for that business. So if you started your business April 1st, every single year, your fiscal year will start April 1st. Liquidity and solvency. Liquidity is the company's ability to convert their assets into cash. Solvency is the business's ability to pay its bills. We look at these two components to understand the company's capital and current ratios. These ratios tell us the company's ability to generate a profit or to maintain positive working capital. Working capital is the difference between your current assets and your current liabilities. So current assets minus current liabilities tells us the working capital. That's the capital, that's the cash, the working capital the company has to make investments to grow the business. If the company has enough money or cash, enough current assets to pay its current liabilities, we consider the company to be solvent. They're able to pay all their bills. The current ratio is a way of looking at the company's ability to be profitable. We take our current assets and divide it by current liabilities. And then there's an appendix. We're not going to go through that. And we're done. Are there any comments, questions, or concerns I can help to answer for you? Or is everyone comfortable so far?
I believe I'm comfortable.
Okay, that's good.
I have a question, but it's back to like chapters 1 and 2 in regards to like creating a balance sheet. I know you say you don't use Excel, so like in case it pops up in like a test or final exams, how would we prepare a balance sheet?
Great, yes. So what you need to know is what is on the balance sheet. You have assets, liabilities, and equity. In assets, you know that your assets are cash, accounts receivable, property, plant, equipment, things that the business owns, right? Liabilities, you know that it's what the business owes, such as accounts payable, wages payable, notes payable, anything payable, right? And then your equity is the difference between the two. That will be common stock, preferred stock, retained earnings. That would be equity. So as long as you know what are assets, what are liabilities, what are equity, and you know that assets equals liabilities plus equity, we know that the balance sheet reads from left to right, assets on the left side, and then you have liabilities and equity on the right side. That's how a balance sheet is comprised. How does it get there? Well, it gets there through the income statements that are generated over time. Your income statement, as you know, has revenue and expenses. And as cash is used for those revenues and expenses, it impacts our cash on our balance sheet and, of course, our other balance sheet items. Does that help to answer your question?
Not really. I mean, I know that part, but I'm saying like if we had to like show you that we know how to create one, if we aren't using Excel spreadsheet, how else can we demonstrate
You
that
won't
we
have
know?
to. You won't have to. You won't have to.
Oh,
You'll go through that exercise through the homework for I think it was chapter 2, but it's not. It's really just kind of selecting what is on there, right? So it's you won't have to create those financial statements. Yeah, you don't have to worry about that. Good question.
that's it. Thank you.
Awesome. You're so welcome. Are there any other comments, questions, or concerns that I can help to answer at this time? I'm sorry that we went over. I really wanted to spend that beginning to kind of get to know you all.
Yeah, no, Professor, I just wanted to know, can I go? I'm feeling well. I just want to rest.
Of course you can.
Yeah, I'm not feeling well, but I got the recording and I'll pick it up. I'll see it and I'll do everything. So everything will be done by Sunday, so you don't have to worry. But thank you so much.
Sounds good. My pleasure. Anything I can do to help, you just let me know,
Okay.
okay?
Okay. Thank
Well, we already spoke, Professor, so
Yep, I understand. Yep.
I'm
Wonderful.
good on my end.
Sounds good. Okay, everyone. If there's no other comments, questions, or concerns, I'd love to call it a day. I hope that you enjoy the rest of your day. You'll stay safe and healthy. And take care. If you have any questions, comments, or concerns, feel free to email me. I'll be as quick as I can to respond. All right, take care, everyone. Thank you so much for your time today. I appreciate you all. Thank you so much.